We are looking at the market structure immediately following the U.S. close on August 3rd, mapping out the forecast for the August 4th open. Please note, this breakdown is for educational purposes and does not constitute financial advice. Leading into yesterday's session, the broader indices suffered a severe multi-day liquidation phase, breaking down through several established support levels. But this S&P 500 one-hour chart shows what happened next. In the final hours of the session, selling pressure abruptly exhausted, resulting in a violent V-shaped price recovery right back to the 7,600 level. This wasn't isolated. The tech-heavy Nasdaq 100 printed an equivalent high-volume recovery, executing a terminal momentum swing up to 28,776. And the Dow Jones Industrial Average mirrored that exact late-stage pattern, testing 53,178 at the close. A synchronized three-index reversal of this magnitude indicates a coordinated defense of local lows. To trade it, we need immediate technical and macroeconomic validation to determine if this move is real. The central tension is straightforward. Does this sudden buy-side action represent a true structural market bottom, or are we looking at a fragile short-covering rally? To answer that without emotional bias, we run the data through a top-down market matrix. Step 1 analyzes the system level, looking at index trends and institutional volume. Step 2 dissects the component level, measuring market breadth to determine exactly who is buying. Finally, Step 3 maps external variables, macro risks that can invalidate the setup. Relying solely on top-level index price action creates a fatal blind spot. A rally is only as strong as its underlying components and its macroeconomic environment. We start by looking for institutional accumulation. This is large-scale capital deployment by funds, which leaves a very specific footprint: extreme volume anomalies at critical price levels. Returning to the S&P 500 chart, we map the relationship between that final price swing and the volume histogram beneath it. The sheer scale of this specific volume bar, printing over 1.06 billion, completely dwarfs the aggressive selling pressure we saw earlier in the concentrated capital required to generate a 1.06 billion volume print at a market low. This is a footprint of institutional sizing. To verify if tech-heavy capital flows validate this broad market signal, we cross-reference the Nasdaq 100. Looking at the Nasdaq leading into the August 3rd close, we see a clear structural higher-low formation prior to the final momentum swing. When institutions defend structural lows with this volume profile, they provide active traders with a high-probability, defined risk entry point. But that entry is only valid if the broader market breadth actually supports the move. Market breadth acts as a diagnostic tool. It measures exactly how many individual stocks are actually participating in an index's upward move, rather than just riding the coattails of the top constituents. This heat map displays sector performance from August 3rd. We use it to stress test the index gains. Isolating the top left quadrant reveals the rally's engine: aggressive accumulation, concentrated in Microsoft, up nearly 5%, and Google. Secondary support came from Amazon and Nvidia. Because these specific companies carry massive market capitalization weights, their concentrated gains mathematically dragged the entire S&P 500 higher. However, stepping back from mega-cap tech reveals glaring divergences that contradict the narrative of a healthy, broad-based recovery. Notice the persistent weakness in consumer electronics. Apple completely failed to participate in the tech rally, closing down over 1.7%. Defensive sector weakness is equally apparent. Major healthcare components experienced localized distribution, with Eli Lilly shedding over 2%. Furthermore, the energy and consumer defensive sectors remained largely flat to negative, entirely refusing to catch a bid alongside tech. This creates a severe breadth divergence problem. An index rising strictly on the backs of 3 or 4 monopolies is structurally fragile and highly vulnerable to sudden capital rotation. Technical patterns and breadth divergences do not exist in a vacuum. They are constantly threatened by external macroeconomic liquidity events. This economic calendar outlines the scheduled releases for the August 4th and 5th sessions, allowing us to pinpoint the primary risk vectors. The single most critical binary catalyst for the week sits at 10 p.m. on Tuesday, August 4th, the JOLTS job openings report. The mechanics here are strict. A hot print, meaning higher than expected job openings, signals a tight labor market. This reignites inflation fears and enforces a hawkish stance from the Federal Reserve. The market reaction to a hot print is immediate. It strengthens the US dollar and rapidly crushes the risk-on, tech-heavy rally we saw on August 3rd. The inverse scenario is a cooling labor market print. This provides data supporting the thesis for upcoming Fed rate cuts. A cool print acts as fundamental fuel. It supplies the exact macroeconomic excuse needed to push the current mega-cap tech momentum higher. Entering aggressive long positions based solely on yesterday's technical bounce while actively ignoring tonight's JOLTS data is gambling, not trading. We consolidate the technical momentum, the narrow tech breadth, and the impending macro event to build our tactical outlook for the August 4th open. The immediate path of least resistance at the opening bell is a likely attempt to push higher, driven by the residual inertia of yesterday's institutional tech buying. But there is significant early session trap risk. Institutions frequently use low-volume morning pumps to distribute shares before critical macro data drops. The 10 p.m. JOLTS release is the definitive pivot point that will dictate the entire session's trend. If the data prints hot, expect a bearish failure scenario. Anticipate a violent rejection of the morning highs and a rapid structural retest of the August lows. Professional positioning dictates remaining defensive and range-bound until the JOLTS data confirms which path the broader market will definitively choose. The August 3rd reversal was technically impressive on the surface, printing high volume at structural lows. But mathematically, it relied almost entirely on a handful of tech giants. Until this narrow market breadth broadens out, and until the price action survives the impending labor data shock, the current structure is a fragile anomaly, not a confirmed bottom. Prioritize capital preservation today. Monitor Apple and the major healthcare components closely. Their participation is required to signal true broad market accumulation. As always, this framework represents a personal analytical view to guide your own research and does not constitute a prescription to buy or sell.